Greetings to you all. This will be the section for the PowerPoint on financial analysis. We'll run through the PowerPoint, and of course you can go back and review it at your leisure. So apologize for the casual wear, but this is one certainly advantage to doing the class via Zoom. So we'll jump right in to the financial analysis PowerPoint. There we go. Sorry, I muted myself there for a moment. Okay, so when we're talking about the use of financial analysis within a funeral home, there's a few components that are important for managers often, especially if they are involved at all in the financial components that come with small business. Some are just managers of people and managers of the operations and so forth. But certainly those that are managers that mostly include owners of funeral homes who often are managers too. These are important pieces to make sure that they're paying attention to and often are overlooked. So we'll begin by talking about what some of the uses, and for some reason, there we go. Okay, so the uses of financial analysis, first and foremost, is to develop and identify trends. So it has to do with cash flow, it has to do with managing debt, it has to do with managing assets. And so we need to gather the information, and then over time, we can identify trends, whether it's in the short term, which again, short term is usually a term that's used for something that's less than 12 months, long-term, something that is greater than 12 months. So we look at short-term trends, and probably more importantly, looking at some of the longer-term trends. And, it can include things like the number of cases that a funeral home is doing, as well as certainly the costs that are involved, the amount of income that's generated, and then putting all these pieces together so that the trends can be evaluated and so forth. So first part is to gather that information as accurately as possible, which is certainly very important that it's being done accurately. And this is going to show the extent or the direction of change that's going on within the funeral home for over whatever period of time you're looking at. So if the change is in a positive direction, that is certainly a good thing. If it's not moving in the direction that you had hoped for whatever reason, digging in deeper to figure out why that's happening is usually the next logical step. So this provides a basis for implementing change. It could be, again, change to recoup revenue or to cut expenses and so forth, or it could mean implementing change that grows the business. Maybe costs that are involved, for instance, adding a new hearse or expanding a physical plant, which is the funeral home itself, making a larger viewing room, for instance, or a room for families prior to the visitation of a private area, things like that. Is looking at these trends and so forth can really help provide the basis for implementing that change. It helps you contain costs so that you understand your costs versus the revenue, and making sure that, again, you've matched up against your goals to figure out whether or not profitability is where you think it should be, and what kind of changes you can make to improve that is one element. It might give you the chance to expand to other ventures. For instance, and in New Jersey, we have some limitations, whereas Pennsylvania, Delaware, it is not quite as restrictive in terms of moving to another venture. For instance, opening up a crematory in Pennsylvania or Delaware, not an option for a funeral home owner in New Jersey. So, but you might expand to adding a hearse and maybe probably not as much anymore, but a flower car or some other utility vehicle that might be used for removals or other things, and then making that available to other funeral homes, so that your staff stays busy, that you use the equipment, and the presumption, of course, would be that whatever that cost is going to be to buy the asset, increase the asset, that it's going to be covered by the use of the asset and the eventual collection of revenue for it. It also helps in financial analysis to determine your relationship of the funeral home to a standard or an industry average. There are various industry publications that provide information based on the size, because they'll break it down, from a fairly small firm to a medium-sized one, to a larger one, to much larger. There's a number of different categories, and then the different ratios that are associated with that, with those firms, can be matched up against what kind of ratios and so forth that this individual, your firm or the firm that's in question, would match up against its peers. It's usually done on an annual basis, and is done by accountants and funeral homes, and in our case, submitting information to this source so that it can be compiled and then analyzed and provide some basis for knowing how you stack up against your peers. You might find that you're very good in some areas. You may find some that are a little bit lacking. You'd like to improve. It doesn't mean that you're making money or not making money, but just how you stack up against those that are of similar size. So in the evaluation of financial statements, we look at what kind of applications that apply to the management of these things. So 4 different categories that make a difference typically are looking at cash flow management. So money's coming in versus money's going out is probably the simplest way to look at that, and whether or not you have working capital, which is another word for making sure that you have monies over and above what your debts are, and being able to whether it's an expansion or adding a person or adding new equipment, you'll be able to evaluate based on your cash flow and how that, we typically don't have a real seasonality to it, but some businesses it really does. There may be summer or winter type businesses, and they have to manage that cash flow a little more carefully. Asset management is another key component. So we're looking at not only the funeral home itself, which is probably the largest asset. It may not be owned by the funeral home. It may be leased, whether it's a family member or maybe someone completely different. Looking at that component, other assets that include vehicles, prep room equipment, all of the pieces of the assets that are inside the funeral home, like chairs and computers and drapes and carpeting. All of those things need to be taken into account, and over some time would eventually, of course, need to be replaced or upgraded or evaluated over time. So looking at managing those assets and making sure that you're getting a return on those assets. When you add something, the presumption would be that you're going to have a net increase in revenue over time. Doesn't necessarily have to be that way, but that's often the goal. Debt management, and this is there's a lot of places that don't have much debt at all. There's some that are what's called leveraged, which means that they're generally their debts are starting to exceed the amount of assets and so forth, which can lead to a situation that might include bankruptcy if that's sustained over a longer period of time. So we want to be able to make sure that the debt can be paid for over a period of time. That might include then some refinancing potentially, if that would help, which flows into the cash flow management. How much money has to go out every month to pay off debts? There may be a mortgage. There may be vehicles that have been financed. There may be equipment that's been financed. There may be your caskets, your inventory, those kinds of things may be financed at some point. And so looking at all of those pieces is certainly a very critical piece. And last is to look at profitability. And there are other uses of financial statements. These are not the only four, but for our purposes, looking at these four areas and making sure eventually that the management of cash flow and assets and debt would eventually lead to a profitable venture, and that essentially you're making money. And it can't be just a break even. Well, I'll take that back. It could be break even, depending on the structure. That would at least mean that you're covering all of your debts, you're covering all of your expenses, which would include personnel and so forth, salaries and so forth. But the presumption would hopefully be that it would be something more profitable than that, so that the business could eventually increase its working capital and other things, so that you have different flexibility. So in order to do that, as we start to look at cash flow management, there are a couple of quick tools that we use. I may be sorry to use that term, but liquidity is the first one. And so, what does that mean for a funeral home and for a funeral home owner? Well, it's an indication of the firm's ability to meet short-term obligations. So liquidity refers to whether or not your short-term assets, which are items like cash, your accounts receivable, you may have short-term investments and so forth, that are all part of the ability for a business to cover its short-term debt. So again, short-term obligations, something that's held less than a year. Certainly cash is normally the largest of that component. And then against whatever the less than 12 months obligation of the firm in terms of its debt. So in other words, you may have a $100,000 mortgage, but only, in terms of principal and interest payments, you may have $8,000 in a year to be paid. Well, that would match up. That's the short-term component of a long-term debt. So it's only the piece that would be payable within the current year. And so you're looking at the ability for the firm to do that. If your short-term debt is higher than your short-term your ability to pay, well, again, that would be an issue to look at. It could be a short-term situation, but hopefully it is just that, because if it's sustained in a long-term place, well, then it's likely that the firm would be insolvent, meaning that it can't pay with its assets, it can't pay off its debt. So we look at two components, the current ratio and the quick ratio. So the current ratio is we're gonna talk about next, and how it's calculated, and what the subtle differences are between the current ratio and the quick ratio. Both of them have to do with, again, liquidity and the firm's ability to meet their short-term obligations with their short-term assets. So in order to calculate the current ratio, it's a fairly simple calculation. So we take the amount of current assets, and of course you have to go back to your to accounting and you know, some of that training. It's looking at a financial statement. Of course, there are three components, right? You have assets equals liabilities plus the owner's equity. So the presumption, again, if there's equity, if the business is worth more than it's obligated to pay, you would have equity. If not, if your debts exceed your assets, well, then in that case there is no equity, and as a matter of fact, you know, the firm could be considered to be insolvent. So you take the current assets, which again are typically cash, any accounts receivable, any short-term monies that may have been loaned if there was a loan that the business made to someone else, and you know, looking at the short-term portion of that would be considered you know, current assets. And you're going to divide it against the current liabilities. So it's that current portion, the portion that's less than 1 year, is going to be your that's going to be due within that year. Those are your current liabilities. So and we'll go through an example in a bit here. So the quick ratio, different than the current, is not terribly different. It just gives you a better ability to look at the firm's ability to pay those current assets. So inventory is another, you know, considered to be you know, a current asset because it can be sold and then turned into cash, presumably, or something else, generally into cash. But it often is not, you know, you're not able to necessarily sell it right away. We have a limited basis to, as we know, we're tied to the mortality rate. So it's not that we can just put out a sale of caskets and have people, you know, wanting to buy, you know, a sale item. You basically are selling your inventory as you need it. So as your demand goes up, then your inventory costs will go up, but also your sales. So the quick ratio is going to, because the inventory especially is not something that's easily converted into cash without some other factors. We want to remove that from the calculation of current assets, and we're still going to divide it by the amount of current liabilities, and that will give us a you know, a real good indication of what the firm's you know, ability to pay. Now, the current ratio, a fairly typical standard for many businesses, is a ratio that would be calculated on the current basis as 1.25, which means that there's 125% of the in assets compared to the liabilities. So if you were using a numerical example, you would have, say, current assets of $100,000 and current liabilities of $80,000. That actually in that calculation would give you 1.2 would be your ratio. If you did 100,000 over 75,000, it would be 1.25. Again, the cushion, if you want to call it that, is the difference between the assets and the liabilities, the current assets, current liabilities, which in this case would be 25,000 in the positive direction. If that number dips below 1, which then means that the amount of assets is less than the current liabilities, then again, that's where you're looking at something that's less than desirable. It's moving into the insolvent category. So you generally want to have at least something greater than 1. Often it's greater than 1.25 at any point in time. And if the firm is doing well, it might be 1.5. It could be twice that. If there's not much debt in the company, it could be even much greater. You could have $100,000 worth of assets and have literally very little debt, maybe $10,000 worth of debt, and then you have a ratio of 10 to 1. So that'll give you some idea. So the threshold is the one. Something less than one means you have more liabilities than assets. Something greater than one means your assets exceed your liabilities. So in the quick ratio, in that example, let's say we had 100,000 in assets and we had $20,000. Let's call it this. Let's say 25,000 in inventory. So giving us a calculation then of in the numerator of 75,000 versus the current liabilities of 80,000 would be something less than one, because the calculation would be 75 divided by 80. But it's not as critical that the quick ratio be greater than one. It does give you an indication as to, if you had to pay something right away, that you have the cash essentially and other liquid assets to pay off the current amount of debt without having to sell the inventory. So hopefully that makes sense. So moving on, we're looking at asset management ratios. For instance, we're looking at the ability on an operating basis. These are a little more fine-tuned than what we just reviewed in terms of liquidity. So there's inventory turnover. How many times in a year? Doesn't have to be a year, but that's often a benchmark. So how many times in a year does our inventory get sold? And that'll give us, again, if we're matching that up against other competitors and so forth and our peers, how we're doing against that. Our fixed asset turnover ratio, and again, it's how much sales are. We're going to go over each one of them in some detail, but we'll just lay them out here. Your total asset turnover. So again, we're looking at sales versus assets, which you look at the income statement versus a balance sheet item, but these kinds of ratios will give you an indication as to whether or not you're utilizing your assets, in this case, adequately, again, against what your peers are. And then the average collection period. Some firms in these days may not have much of a collection period to begin with, because you may have everything being paid upfront, whether it's through prepaid funerals or if it's credit cards, things like that. That at the arrangement, the funeral is being paid. Therefore, there may not be a collection period much at all, if anything. That's probably becoming more and more the trend. But for firms like ours, the one that I work for, we do have we do provide basically financing for every family that comes in the door, and therefore we have accounts receivable. And so looking at how long and how many days it takes us to collect on that money is certainly worth evaluating. So in reviewing each one of these in a little more detail, when we talk about inventory turnover, it's how many times you're selling your inventory. So if you have $100,000 worth of assets and you have $1 million worth of sales, then the quick calculation would be that you are selling your inventory 10 times in a year. So roughly every 35 to 40 days, you are selling your inventory. It is being converted into sales. So that's a very quick, and keep in mind that on a test, it would be some fairly simple calculations like that. And you will be able to use a calculator if you'd like to use one. That'll be perfectly fine for the exam. So in order to calculate this, we're going to take the cost of our sales, okay, and we're going to divide it by the average inventory. So our cost of sales is one thing that's different than your actual retail sales, but if your inventory is costing you on those $1 million in sales, let's say that inventory is costing you 500,000, and your average inventory, again, usually over a period of time, can be calculated at different points in time, but usually, let's say at the end of the year, it's calculated, it's at $100,000. So your cost of sales of 500,000 over your average inventory of 100,000 would mean that you're selling your inventory over a 5 times, and that kind of takes the markup end of things out of the equation. It's concerned with what it's costing you to buy and present the material. So your cost of sales may not be just the raw casket, for instance, but you've got some other sales components that may be included in that, so you might need to calculate that in there as well. Your fixed asset turnover is comparing the amount of sales to the fixed assets of the funeral home. So your fixed assets are your longer term assets. Again, that term of fixed versus current. A fixed asset is something that is normally something that has a shelf life that is longer than 1 year. It does not include inventory, those kinds of things which turn over, as we looked at in that the last slide. This is going to compare your funeral home. Typically, again, if you own that asset, your equipment, your transportation, your hearse, your removal vehicle, those kinds of things, and comparing how much sales are being generated based on those amount of assets. So you take the total sales, and not the cost of sales that we did in the first ratio of inventory turnover. We're looking at the amount of total sales against the amount of fixed assets. So in our example, maybe we said we had $1 million worth of sales in a year, and the fixed asset component might be something much greater than that. Let's say $2 million in fixed assets between all of your equipment and the real estate and so forth. So you're then having a ratio to see how much sales dollars are created by comparing it to the fixed assets. So in this case, it would be $1 million over $2 million, which is essentially 50 cents on a dollar is being supported by those fixed assets. And that may not seem like much, or that may not be seem like it's worthwhile to calculate. But when you look at what your competitors might be doing, if they have less assets but they're generating greater sales, you might want to reevaluate that, and vice versa. You might be doing better than that. So maybe you purchase some additional assets that presumably would also translate then into to sales. So maybe again, it's another hearse or a removal vehicle or some new equipment or whatever it might be. Increasing the amount of fixed assets might give you some indication as to an increase in sales. And it's useful on a year-to-year comparison for the firm, just to see if your assets again are and your assets are going to be subject each year to depreciation. That's kind of a discussion for another time, but each year, not only for taxes, but it is prudent to make sure that something that you buy for $1 million now presumably is going to not be worth as much as time goes on. And maybe that's not a good example of $1 million, but let's say $100,000 hearse. Well, over time, say over 5 years, that hearse is not going to be worth $100,000 any longer. By depreciating it, it may be worth $25,000 at the end of 5 years, or $50,000. It depends on what the asset actually is. So So those number of fixed assets generally is going to decrease unless you add new ones. So your total asset turnover indicates the amount of revenue or sales generated by the total assets of the firm. So now we're not looking at just the fixed assets, but we're looking at the entire assets. So your short-term portion, your cash, your inventory, your accounts receivable, and then measuring that against what kind of sales are generated. So we're again taking that same amount of $1 million, and we said that we had fixed assets of $2 million, but we have another $500,000 worth of short-term assets. So our total assets would be 2.5 million. So again, in that case, you do the calculation of $1 million over 1.2, 2.5. So 1 million over 2.5 million in assets, and in doing that calculation, you should come up. It's going to be certainly, of course, less than the 50,000 or the 50 cents that we said before, based on the sales dollar. So in this case, when you're doing that, it's going to be 40% or 40 cents on the dollar in doing that calculation. So if that makes sense for those of you who like to see it numerically. So your total assets are your current and your fixed assets combined. Now, the average collection period, this often, again, for some firms, it doesn't really make much of a difference at all, because they don't have much in terms of any collection. They don't have any accounts receivable, or very little. So it's not a worthwhile calculation or evaluation. But for those that do, this can be a key component to look at. So it's saying how long is it going to take you to get paid for the work that you've done. If you're getting it up front in an arrangement, well, then it's you don't have to worry so much. But if you're not, then again, let's look at what that would mean. So in order to get to what that average collection period is, we're going to take our net sales. Net sales means, and for a lot of businesses, this takes into account something that we don't generally have to worry about, and that is the sales. And then if there was some returns on the sales, you would have to, if it was a clothing manufacturer, for instance, or a retail store, and they had $100,000 worth of sales in a month, but they had 12,000, easy numbers, let's say they had $10,000 worth of returns, which could have been from a previous time frame, but regardless, in that time frame, now you have $100,000 worth of sales, and you're going to subtract the 10,000, giving you $90,000 of sales. For us, it doesn't make that much of a difference, because we generally don't have returns, so we could just use it interchangeably as sales. But just know that the calculation for other businesses is something slightly different. And we're gonna divide that by the amount of accounts receivable we have. So if we have sales of $100,000 and we have $75,000 worth of accounts receivable, we're going to complete that calculation. And in here, I'm saying that after returns, as we just discussed, and it's your average accounts receivable. So you because the accounts receivable is a balance sheet item, and it's looking at a particular point in time. You do need to be careful that making sure that if for some reason you have an unusually high or unusually low accounts receivable at that point in time, you might want to look at where it was every month for 12 months and then average that, so that you get your average accounts receivable. And you'd probably want to do the same thing with your sales too. So that calculation is going to give you your accounts receivable turnover. So how much, that $100,000 worth of sales, and you have $75,000 worth of accounts receivable, then you have something that's greater than 1 in terms of your turnover. Then what you do is take that number, the accounts receivable turnover, and you're going to, in the denominator, and you're going to take 365 days and divide it by whatever that calculation was. Okay, and that's going to now give you the number of days in accounts receivable that you have. Whether you know, what would be typical might be somewhere close to 30 days if typically what you do is generate your sales by like in my case, where we provide credit basically to everyone, but it could be a mixture. You might have some sales that you're getting from credit cards, or it might be sales that are being generated from pre-planning, pre-arranged and pre-trusted funeral dollars, because that's going to be basically like getting paid in cash. So if the number of days is high, it's not automatically a sign of poor management. It could sometimes just be a function of you know, a particular point in time. It often can be, though, if that starts to increase to 150 to 180, you know, the more days that your average receivables are, the less likely that you're going to be able to collect on all of it. So because as time goes on, you know, people become less and less likely to pay off their debt. And a low number is not necessarily a good sign either. You know, one of the things that having receivables is, if you have a slow month, for instance, if you're currently having a slow month, if you had a better month, the one before that, well, you're still going to be collecting money because you're collecting from the previous month's accounts receivable. So, you know, having a low number, you know, someone might say, well, we only want to have, you know, 5 days worth of accounts receivable. But if you have a slow couple of weeks, you know, having something that's 30 days, it means that you've got monies that are coming in over time. And then looking at an analysis of those changes over time might indicate problems, or it might do just the opposite. It might show some stability, depending on how those ratios work out. And well, I'll go over. I'm going to send you some examples, some numerical examples, you know, as well. So we also can compare that to those industry standards. You know, if and it gets a little tricky in terms of funeral homes, because again, there's a lot of funeral homes that don't have any accounts receivable, or very little accounts receivable at all. So that would be kind of skewed. And then we look at an aging of receivables. Many of you, if you've been in other businesses and so forth, might be familiar with this. And this just looks at you know, the amount of time that that our receivables are between the time that we had the sale, so generally when the funeral was, to when we're actually collecting the money, and what's owed over that period of time. So it's normally done, you know, as what would be considered a current receivable, which is something 30 days or less, then up to 60 days, up to 90 days, and then anything greater than 120 days. From an accounting standpoint, an accountant might say that anything that you have that is an account receivable greater than 120 days, it might consider that to be uncollectible, and you actually might have to either reverse the sale if you're doing an accrual basis for your accounting, or you know, write that off, and then when the money comes in, you would just write that in as a sale at that point. For those that don't use the accrual basis of accounting, but use the cash basis, this is not as critical for an accountant, because they're only counting the money as it is coming in. So, you know, you might use this as a tool to figure out whether or not you can count on a certain receivable being collected. But you know, when your cash basis is being used for your accounting method, then you're only recognizing the sale basically when you collect the money anyway. So even if it was a receivable from 5 years ago, you know, you're going to recognize that in the period when you actually collect the money. So some debt management ratios. And so we've looked at so far, you know, our in our cash flow management, we've looked at things, and we've looked at our some asset ratios, and now we're looking at some debt management ratios. And this will be an indication of the financial risk that the firm is taking. So high debt ratios mean a larger debt, generally with fixed, larger fixed interest payments. And overall, there's that term leverage again. So if you're considered to be leveraged, it generally means that you have more debt than someone that is not as leveraged. A favorable leverage, and this is why it's not necessarily a bad thing, is favorable leverage would indicate that you're earning a higher return on the borrowed capital, which means loan proceeds, if that's what it is, or raising money from someone in a private market, than the cost of that capital. So in other words, if you're borrowing money at 5%, but you're able to generate profitability and sales of an additional 7 or 8%, well, your asset now is being put to use, and your capital is generating more money than it's costing you. So when it's the other way around, that gets a little tough. And sometimes in the short term, we have it that it's not as favorable, but then over some time, for instance, when you're building a new an addition on a funeral home, it may take some time for that return to be seen, and therefore, your leverage is seen more favorably. So, the debt ratio is a common one, is to look at the amount of total debt versus the amount of assets that you have in total assets. So your total debt is your total liabilities. So it's your total liabilities divided by your total assets. And this is a number that, of course, you don't want to see increase more than 1, because if it is, that means that you have more debt than you have assets. And conversely, that means that you have no equity because again, total assets equals total debt, or total liabilities, another term for it, plus owner's equity. So if you have more debt than assets, that means that you have no equity. You may have a negative equity situation. So you'd rather see that number, something less than, certainly less than 1. And the lower that you go, the more it means that you have a greater number of assets than you do debt. So it shouldn't exceed 1 to 1, or in that calculation. And I think I just explained to you why, because if not, then it might be an insolvent situation, and might be potentially moving towards something like bankruptcy. Looking at another debt ratio is the debt to equity. So we've been looking at assets and equity, or assets and liabilities. Now we're taking a look at the liabilities, or that total debt, and comparing it to the amount of owner's equity. So this number will typically be greater than 1. And if it's less than 1, that's really a good thing, because that means you have more equity in the company than you do total liabilities. So in that example, let's say we had $500,000 worth of liabilities, but we had $1.5 million worth of owner's equity. So 500,000 divided by 1.5 million would be a 33% debt to equity ratio, because you have one divided by 3, essentially. The calculation would be 1/3, or 33%. And again, that's a number. It doesn't necessarily mean, if you had $1 million in liabilities and you only had 250,000 in equity, that would be a 4 times ratio, as opposed to that 33%, or a 0.33. So 4 versus 0.33 doesn't necessarily mean a bad thing. Just means that you have $250,000 in equity versus the $1 million in debt that you have. Of course, adding those two numbers together, if we had $1 million in liabilities and we had 250,000 in equity, Your total assets, of course, then would be 1.25 million. You'd add the liabilities plus the equity on the other side of the equation, that would equal your total assets. So the times interest earned, this is going to indicate the number of times that interest payments are covered by the operating income of the funeral home in this case. We're interested in figuring out if there's any fluctuation in the revenue. It can be there can be some danger that you're not being able to meet your interest obligations. So it should be something that is something, of course, greater than one, but it gives you the calculation to figure out whether or not you can cover your short-term debt that would be, and if you don't have any debt, then maybe your interest payments are very little. But if you do, then it's worth looking at. So in terms of our profitability, our net profit margin ratio would take our net income, again, assuming that there might be some return of sales for us, that not usually. So you're going to, we can look at it more just as income versus sales, but for other businesses, the net income versus the net sales. So if we had $1 million worth of sales and we had $100,000 in income, we'd have 100,000 divided by $1 million, or 10% would be our net profit margin ratio. So our net income is going to be net of taxes, of course, not only returns on sales and so forth, but making sure that it is the number that is generated, completely after paying all of our associated debts. So your return on total assets, or ROA, it's often referred to, it's going to indicate your profit on your total assets. So it's going to take the net income and compare it to total assets, not sales in this case. But that same $100,000 in income versus assets of, we're going to say maybe assets of 2 million, then that would be a 5% return. So 100,000 divided by 2 million should give you 5% as an ROA. Conversely, then, if we're looking at versus assets, we look at the return or the net income versus the amount of stockholders' equity. So in our example of $100,000, and if we had a $250,000 in equity, then we're earning basically a 40% return on our net worth. Pardon me. So again, just a reminder that the stockholders' equity is not only what the owners have initially invested, but what they continue to invest by keeping the money, not taking it out in distributions and so forth, and allowing that equity position to increase. So now we move more directly into some things that are specific really to funeral service. And I'll preface it by saying that these are things that I really don't think are calculated all that much from a practical standpoint, but from the standpoint of your national board exam, it is still a component that is that comes up on those exams, and so you need to know generally, of course, what it is, but then how to calculate these a couple of ratios, and it has to do with how we're comparing the amount of sales and so forth to the value that a consumer is going to receive. So it's looking at the percentage of merchandise that we're selling compared to the total costs of a funeral. So we would take the wholesale cost of merchandise. So and it's generally speaking something large like a casket. But if we're really doing the whole calculation, it would be adding whatever our costs are for caskets, whatever our costs for a vault, what it is for our register books and prayer cards and all those things that are considered to be merchandise that we're selling. Take into account what the cost is, and then compare it to whatever the total funeral cost is for the consumer. So that's casket, vault, service, and other costs. So in the wholesale costs, of course, is we don't have things like service and things like that. We do have and that's what it's costing the consumer. So on the left-hand side, the wholesale cost of the merchandise for a casket, for instance, might be $1,000, but the price to the consumer is $2,000. So when we do that calculation, we're going to figure out exactly what the ratio is of the cost of the merchandise to the entire funeral. The other important one, we'll go into some detail on both of these, is the Consumer Value Index, or the CVI. And this is specifically going to look at, again, that same number in the numerator, the wholesale cost of the merchandise, and then it's going to compare it to just the retail price of the merchandise. Whereas in the previous calculation of MVR, we're adding in service and everything else that would be associated as a cost to the consumer. And in this case, we're really just looking at comparing apples to apples, what it costs us versus what we're selling it for. And then in that calculation, it's going to, the consumer isn't going to know what that number is because they don't know or shouldn't know what your wholesale cost is. They certainly know what their retail price is. But it helps give an indication as to what kind of value the consumer is receiving. And that's one of the important parts. So, and I apologize, I guess that's going to end for this PowerPoint. We will go into, in class, we'll talk some more about the MVR and the CVI and go through some examples and so forth in class. I hope this has been helpful. Certainly feel free to play it back and ask some questions if you need to, but we'll go over any questions that you might have in class when we get together next week. Again, thanks so much, and we'll see you on Tuesday.